Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, it's going to be a very good day. It has been a very good day. Why, you might ask? It's because the doubters have been proven wrong. Time and time again, there's been a narrative and a notion online that Google is going to get disrupted, it's going to zero, AI is an existential crisis for this business, and that inevitably, the monopoly that has been dominating the internet search business for the past 2 decades is going to come to an end. AI is finally the catalyst which brings the end of Google, the behemoth that has left its mark on literally the world over the past 25 years. And the reason I say it's a very good day is because I've taken the opposite side of that coin. I think Google's monopoly is perfectly intact. There's not maybe a couple scratches here and there, maybe some very niche specific AI use cases for example, like education, or like there's a AI LLM that could do very particular things better than what Google is able to do. But other than that, today's move is part of a roughly, I want to say 22% move over the past, give or take, 3 weeks or so, bringing Google intraday to $200 per share, crossing that mark, at least split adjusted, crossing that mark for the first time ever. And that actually brings our total to 42% year to date, massively outperforming the market. And so in today's video, I kind of want to give an overview of the AI saga that we've gone through over the past year, with the constant narrative changes with Google being seen as an AI company and then not seen as an AI company. A certain catalyst comes up, all of a sudden Perplexity is going to disrupt Google, it's for certain, whatever. The DOJ case happens, all that type of stuff. We're going to get into it. But before we do all that, I want to take a trip down memory lane and kind of show you some receipts. I've been consistently bullish on Google, and if you don't follow me on Twitter, you 100% should, because I consistently post stuff like this. And dating back to early September, when Google was trading below $150 a share, I was consistently making tweets talking about how incredibly cheap the business is. How I think even though like it's relatively close to the all-time high, the fundamentals of Google have massively improved over the past couple of years. And so sure, it is trading at all-time highs, but it's incredibly cheap compared to its historical valuations. What better way to look than to look at the forward PE of the business over its historical averages and over the historical ranges in which it has traded at. You could see that at the time it was trading at roughly an 18 PE, and that's on the lower bound of where the forward PE tends to kind of stay at. It usually trades above a 20 PE, and it maintains that level while it's growing the EPS at like 20% or so. And I posted this September 6th, so it was in the low 150s at this point. In that same tweet, I half jokingly, half being serious, of course, not financial advice ever, but I literally put, this is financial advice. Again, somewhat sarcastic, but the point still stands. It would have been a great opportunity to be picking up shares of Google at like $150 a share. I think doing some very quick math, we're up roughly 30% in 3 months. A wonderful return. That's, I believe, more than the S&P has returned year to date. You could have had that in the past 3 months, simply just buying Google, which is, one of the most durable, well-known, established, dominant businesses in the world. I even made a video about it, which I quite literally titled, "The Most Obvious Buy of All Time." I'm not sure if there's any particular way which you could misconstrue the goal of that video, the sentiment I had towards Google at that time. And actually, that video literally marked the bottom of Google. On September 9th, you could go back on the historical chart, and that's the day where it hit, I believe, $148 a share. On the other ticker, it hit $148 a share, and it's been straight up since then. So I literally timed the absolute bottom. Of course, there's a good amount of luck involved with that, by uploading this video and the tweet that you guys just saw, calling it the most obvious buy of all time. Google, at current valuations with the growth profile and the moat that Google has, I feel like it's a no-brainer. Especially at a time when the trailing PE ratio of the S&P 500 is sitting at 28, Google starting to look like a bargain. I would never directly endorse or tell you to go out and buy shares, but I mean, if you're not pulling the trigger on Google at these prices, at a historically low valuation, with seemingly nothing really wrong with the business, like at the lawsuit thing, we didn't cover that, but I mean, that's just going to come and pass. You saw earlier in the year, they had the AI demos that went horribly wrong. I'm not denying that, but I mean, that just came and passed, right? Like the stock sold off because of that, because the uncertainty, whatever, blah blah blah. But it came and went, right? I think the same thing about the lawsuit earlier this year in April, I want to say, with Apple. So I'm going to stop right here, but the lawsuit indeed came and passed, right? So I don't know. It seems very scary at the time, and maybe for newer investors, I haven't even been in the market that long. I think I've been in the market for about 3 years now, right? So fall of 2021, I started investing, which is actually coincidentally right at the market peak. But anyways, these things come and pass. Like, it looks really scary at the time, but you kind of build that muscle over time of like, great businesses will continue to be great regardless of how scary the narrative seems at the time. And this is like, if you're going to take, I repeat this so many times in all my videos, if you're going to take anything out of any of the videos I make up your own mind. Don't fall into the narratives. Go look at the research. Go look at both arguments. Don't even listen to me. I'm just permanently bullish on especially companies I own, which perhaps I'm a little bit too optimistic with these type of things. But still, listen to this side of the argument. Listen to that side of the argument. Look at the numbers yourself and rationally, objectively decide for yourself whether or not that's a risk that you're comfortable with taking. But please, for the love of God, don't fall into the narrative-based trap of, oh, the DOJ's coming after Google. They're going to split it into a million pieces. Chroma's going to get sold off for pennies. YouTube is going to get split and whatever. Right? Like, make up your own mind. And so with that being said, I kind of want to look at like, where do we stand now? In order to do that, I'm going to use this wonderful website, finchat.io. And so I already have my portfolio loaded in here. And as you can see, I currently have a 17% position in Google. This is up from, I believe, like an initial cost basis of roughly 14%. Kind of hard to look at that because at the same time that Google has gone up, Amazon and the other holdings have gone up. So I don't know how the proportions of that necessarily work. But currently, because of the incredible gains that we've seen in the past couple of weeks, I'm sure many of you guys are wondering, has Google ran ahead of its fundamentals? Is it too expensive? Is it possibly the time to maybe sell out or at least like trim a little bit of the gains, try to lock them in? Is the market too euphoric? Because at the end of the day, the current catalysts that have kind of driven Google stock up, the Sora or the Willow and all that type of stuff, all the like cloud computing AI chips that they kind of came out with in the past couple of weeks, realistically, we're not going to see any commercial applications of those things for probably a very long time. It's not instantly monetizable. It's just these projects that they're kind of working on that are cool. That's ultimately what they are. Like the Willow thing, they solved that equation or whatever. Okay, now what? Right? Like, where's the actual applications of it? I guess it kind of speaks to what they're kind of working on in the background, and maybe the market is optimistic of that. But at the end of the day, Google is still yet to prove what these AI applications are eventually going to turn into. Are they using them internally? Will it, again, have some sort of commercial use? We really don't know. So in order to kind of measure the valuation and take a look at that, I'm going to jump over to the charting tab here on FinChat. I already have Google here at the top, but we're just very simply going to look at some very basic valuation metrics. So forward PE for starters, this is what I had been tweeting about earlier on. So we could see that when I was making the videos and making the countless tweets talking about how cheap Google is, and literally on the day I came out with that video, on September 9th, it was trading at an 18 forward PE ratio, and currently it has risen. We've seen some multiple expansion, which is partly contributing to the gains that we've seen with Google. I believe we've had a quarterly report since, so there has been some actual EPS growth on top of that. And Google today trades at roughly a 23 forward PE ratio. So definitely there has been some multiple expansion, but I mean, even if you compare that to the historical averages, we're still slightly below the 10-year forward PE average. And if you want to look closer, if you want to look at the past roughly 5 years, again, it's somewhat similar. It's a 23 forward PE that we've seen averaged out across the last 5 years. So I wouldn't necessarily say Google is expensive per se, but at the same time, like, this isn't the same business that has existed over the past 10 and 5 years. Maybe in the future they have slower growth rates, and naturally a slower growing business should probably have a lower valuation multiple placed on it. And so naturally the next thing we should look at is, how is the business growing? Again, if we just simply look at very basic metrics, so we look at the total revenues, I'm going to toggle on the percentage change. Oh, I accidentally got rid of Google here. So we bring Google back and we look at the percentage change of the total revenues. I'm actually going to hide the actual total revenues number. And then let's do the last 12 months. So what this does is it takes the last 4 quarters and it plots it over time, right? So we see that as of Q3 2024, in the past 4 quarters, Google has averaged a 14% revenue growth rate. And you can see that this has been elevated in roughly like the 2017, 2018 timeframe. We saw a dip in the pandemic period, a massive boost post-pandemic as a lot of people were getting online. Naturally, that brings up ad rates, a trough when the interest rates were raised, and then now we're kind of stabilizing and increasing back up to like a mid-teens revenue CAGR. And so actually we're seeing an acceleration in terms of the revenue growth. If we chuck this on just the quarterly view, you could see that for a couple quarters in a row, it's hovering around that like 15-14% mark. And so if we want to kind of dive into what specifically is driving this revenue growth, we could do that by going into the segment and KPIs section. And if we go here, we could see the different revenue segments of Google. So of course you got your YouTube, you have your Google search, Google network revenues, Google subscription. So like the people that pay for Gmail. And I think YouTube subscription is also in here. And the two key ones that I kind of want to look at is the Google subscriptions and the Google Cloud revenues. The reason for that is that both of these are very similar in terms of total revenue. They're doing about 10 billion a quarter, or roughly 40 billion per year over the past 4 quarters. And what's interesting about these two is, again, if we toggle on the percentage change, and I'm just going to click hide on the actual absolute dollar value, you could see that both of these are the fastest growing revenue segments of Google, growing at 20 and 30% respectively. If we go down to a quarterly view, that we could better see that actually in the most recent quarter, they've both, sorry, I'm blocking with the face cam here, but we could see that in the most recent quarter, the cloud segment grew at 35% year over year, and the subscription segment grew at 28%. So about a quarter of Google is growing at like roughly 30%. That's going to leave a meaningful impact on the total growth rate of revenues. And one last thing here before we move on to my valuation spreadsheet, if we toggle on the Google search side of things, which this is like 65% of total revenues is just the search segment. And then again, we toggle on the percentage change to kind of take a look at that. You could see that that segment of the business is growing at 13%. So what's beautiful about Google is you have the total revenue growth rate of the business is being carried by these other segments, such as the subscriptions and the cloud revenues. And so even the DOJ case, which we kind of mentioned earlier, that side of the business is very prone to regulation. Google is kind of diversifying away from that because you have the core Google search business growing at 13%, and you have the other two growing at 30%. Naturally, those two are going to make up a higher and higher percentage of the business, creating diversification within the revenues. Naturally, that should actually help with the cyclicality that comes with the business as well. Again, the software we've been using all video long here, this is finchat.io. I personally use it every single day. It would help out the channel massively if you just try it out for free. Top link in the description. And to be honest with you, it genuinely saves me hours and hours of time, and I'm able to drive incredible insights by just looking at the numbers because they're right in front of me. It's visual and I absolutely love it. And so to kind of close off the video, I want to run through my valuation spreadsheet. Long story short, what we're doing here is we're taking the current valuation of the company and we're dividing by the expected future growth rate of the business. And we're talking about free cash flows here. So the current price to free cash flow divided by the future free cash flow growth rate of the business. The issue with that is that currently Google isn't exactly optimized for free cash flows. So I've put a little disclaimer here in the purple here. Essentially, I just took the average free cash flow margin of Google and I'm extrapolating that as if Google had been optimized for free cash flows today. And even though I made some back of the napkin adjustments in favor of Google, it still doesn't trade too attractively compared to other possible opportunities in the market. Keep in mind, this is free cash flows. So on a PE basis, it's absolutely still like a home run investment. It's trading at the market average. It's going to grow EPS at like 15-16%. The PEG ratio is still incredibly attractive, but on a free cash flow to growth basis, it doesn't look too attractive. Currently, we're at a 44 adjusted price to free cash flow. For the people who prefer it in yield format, that's roughly a 2.5-2.6% free cash flow yield. So again, not crazy attractive. And then if we assume that it grows at 17%, some peers that you could kind of compare Google to would be like MasterCard or Ulta Beauty. Like it trades somewhat expensive. It's not too far off the market. Again, on a free cash flow basis, on a PE basis, it looks still incredibly attractive. And so do I think that it's so expensive to the point where we got to sell out and it's borrowing from future returns? No, absolutely not. I don't think it's gotten to that point. I don't think Google is unbelievably expensive. It's priced to perfection. Something like Costco, for example, right? It's at a 60 PE growing 8% per year. I think that business is priced to perfection. It's going to grow the bottom line, but it's going to be flat. The stock is going to be flat for multiple years and possibly down, right? So I think that business is ridiculously expensive. But at the same time, I don't think it was cheap like it was literally a month or two ago, right? Where it's pounding the table and urging everybody to buy into this incredible business. And so instead, I'm kind of looking at some other opportunities, even Meta, which is like also at all-time highs. I think that trades more attractively just purely off the back of a better growth profile and easier to follow free cash flows. I think Uber is still an incredible buying opportunity. And actually, that's a very fun comparison because currently Uber is kind of facing the narrative fall where Google was 3 months ago of like, AI is gonna disrupt Google. Now we've got robo taxis are supposedly gonna disrupt Uber. It's for certain. Send the stock down to 30 times adjusted cash flow, which actually, if you want to take the year-end free cash flow number, it's trading at 27 times free cash flow, adjusted for stock-based comp, right? So like almost a 4% free cash flow yield for like a 25-30% grower. Unbelievably cheap. Actually, let's put it up to 30%. It's trading under 1 times free cash flow to growth, which you should watch my video on Uber. Usually 30% is like an egregious estimate to do any type of growth for any type of metric to be growing that fast. For Uber, it actually might make sense. Again, I'm going to urge you to watch the Uber video for full context in that number, but that's not like crazy out of the world. That's like a slightly aggressive case that can actually happen, right? And so that kind of wraps it up. The AI saga. Google was supposedly going to get disrupted, and yet the stock and the numbers and everything in between continues to race higher. There's absolutely no signs of this business being disrupted, and odds are consumers are going to continue to use Google, and they're not going to change behavior. With that being said, thank you very much for watching. Again, check out FinChat, top link in the description, as it is the best stock research software on the planet. And also, you should subscribe because it costs you nothing. Thank you for watching, and have a great day.